And the Treasury bills market sustained its positive run after the OMO repayment of 106.2 billion naira. Well, traders at Axis Bank say they expect a mixed performance in today's trading. Ladi Belo, fixed income trader at Axis Bank, joins me for a midweek update. Ladi, thank you for joining us today. Let's start with you bringing us up to speed on trading at the different market segments, starting with the money market.
Good afternoon. Thank you for having me. So yesterday we actually opened with system liquidity being slightly bolstered, coming from the OMO maturity, like you said, of about 106 billion. This kept us at around 250 billion in terms of market liquidity. And by and large, we saw the OPR and overnight rates drop significantly by an average of about 450 basis points to close around 4.5% on OPR and about 5.2% on the overnight rates. This had quite a significant impact on our markets in terms of the treasury bills, both the NTB and OMO space, where we saw, coming from the mixed sentiments on Monday, we saw slight bullish sentiments, which was skewed towards the longer tenured maturities ahead of the NTB auction that is scheduled to be conducted by the DMO, which was done this morning. Last stop rates on the long end closed around 4.35%, which was a significant drop coming from the preceding auction, where the auction closed around 5.2%. But this time around, we don't expect to see such a sharp decline in the yields in our market, but we still expect to see some level of demand given the subscription stemming from the idle cash that we've seen over the last 24 hours. So we expect rates to close around the sub 4% levels, 4% at the very best, given the attractiveness of the one-year NTB at the moment, as well as the limited investment outlets that we have in our market at the moment.
Now, what about the bond market? Take us through the trading at the bond market across the yield curve.
Okay, we've seen most of the activity skewed towards the shorter tenured maturities. That's the 23s all the way down to the 2026's maturity. A little bit of interest on the 27s and the 28s as well, but we know that the 29s and the 45s are fairly liquid. By and large, it's been one directional in the bond market as well, with a bit of profit taken today. Generally speaking, the yields have hovered around the 4.5% handle on the short tenured instrument, that's the 2023, all the way up to around 12.8% on the 2050 maturity. So we've seen a bit of segmented trading where the short to medium tenured instruments trading a bit more actively than the long tenor. That's the 30-year or 20-year reopening. That's the 2042, which is currently around the 12.7% mark. This is just simply because of the fact that there's excess liquidity in the system, like I said earlier, and market participants, especially the local players in the market, will rather deploy their idle funds to the short to medium tenured maturities, given the slight expectation of a hike in rates as the months progress, as we approach the pre-election year.
How would you describe investor sentiments? I know that, for a long time, negative real return, that has been the order of the day, inflation at 15%, limited investment options. We have the, big institutional investors like the PFAs who must, make good returns for their clients, etc. And so, we're approaching the end of the first quarter. How would you describe overall investor sentiment, and what is the thinking in terms of what they can expect or should expect in terms of rate? At 4%, that's quite low, but we haven't seen any resistance point. They keep going lower. What are your thoughts?
Well, 4% is an acceptable entry point for local investors at the moment, because the counterparties who are heavily trading these instruments are banks, which means that they have the opportunity to rely on their idle cash and take arbitrage positions. The primary market has proven to be a good source of returns when compared to the secondary markets, with a bit of arbitrage in between those markets. Having said that, there will at some point be a bit of resistance, just like we saw 2 years ago in the market. At some point, the market will start resisting these fairly low rates, but as it stands, as long as there's some carry opportunity in between the primary and secondary markets, we'll continue to see a bit of pressure, especially on the short tenured instruments, both within the NTB space and within the short tenured maturities. We have the PFAs who have no choice but to invest in our market as well. They have a mandate to invest a portion of their funds to the debt capital market. and as a result, we'll continue to see them come into our market and take a bit of position, no matter how little, as they have idle funds to deploy. We're seeing a bit more interest from the offshore counterparties who essentially have the arbitrage of the OMO space. They come into our secondary market and have found a bit more comfort in participating in our bond space, given the ease of repatriation that they've felt over the last couple of weeks. The I&E turnover has been strong this week. We've seen on Monday till today an average of about just north of $100 million daily. So fairly healthy flows, which has kept the I&E and NAFEX rates fairly stable at around the 415.66% mark. So we saw the appreciation in our Naira rates by about 4 kobo yesterday.